Let's bring you an update now on the state of the economy, and the latest figures on the job markets have been released within the last few moments. Caprice is here. Hi, good morning. What are they saying?
Yeah, there's a lot in this report. We have data on employment and unemployment, but also vacancies, redundancies and wages. And the big picture is that the labour market is now feeling the strain of low growth, sluggish growth, high interest rates and high inflation. The unemployment rate ticked up to 3.9%. We thought it would stay the same at 3.8%. But 3.9%, it's still pretty low by historic standards. The labour market is still actually pretty tight. And that's putting pressure, upward pressure on wages, which rose by 6.7% in the year to March. That was up from 6.6% the previous month. Now, sounds like a pretty chunky pay rise, but important to point out that 6.7% is still considerably below the rate of inflation, which is in double digits, which means we're all getting poorer. And the Bank of England won't be happy about 6.7% because although we're getting poorer, it thinks at that level it could still fuel inflation. And it's been aggressively raising interest rates to try and stamp out inflation. Economists thought that that would start feeding through into higher unemployment in a big way. That massive surge in unemployment hasn't quite happened yet. And it's a similar story across the economy. We thought we'd be in the midst of one of the biggest recessions in modern history. Hasn't quite happened yet. So overall, the economy is more resilient than we feared it would be. But it also means that inflation might prove to be a little bit more stubborn than we thought it would be.
Brilliant.